about how the way you invest will affect your tax situation. And one thing we want you all to know just before we even get started is that there's a thing called short-term capital gains as it relates to really the stock market is the asset class we're talking about today. And short-term capital gains means that it's an investment that you went into. You held it for less than 12 months, not the calendar year. So please don't get this confused and think, well, I held it beyond December. It's 12 months from the day that you purchase it, not the calendar year. And then that's short-term capital gains, anything before that. Long-term capital gains would be anything 12 months in a day. Again, from the day that you bought it, not looking at calendar year. And some of you all might be thinking, why does he keep saying calendar year? I've seen and spoken to people that when it's December, they just assume it's the end of the 12-month period, but they just bought the security in November. And I've tried to explain many people to this concept, and it got convoluted. So I figured, let me go extra clear in saying 12 months from the day you purchase it. And anything less than that, again, short-term capital gains. 12 months in one day is long-term capital gains. All right. So Leon, while you tell us why we chose this topic, I'm going to do a little bit of housekeeping.
Yep. So chose this because I was doing some research recently on taxes and investments, and I thought it'd be a pretty good topic. And what we're going to show you is the interesting part is how increasing your total income can actually lessen your income tax, which is crazy. And this is what rich people do all the time, because they use their investment income as a part of their income, which again will show you how it can lessen your taxes. So to give a quick scenario, let's assume January of last year or all of last year at your job, your W-2 job, you made $95,000, right? And $95,000, you're going to be taxed at 22%. That's the tax bracket you're in. So that number is going to be $20,900 you're going to pay in taxes, right, out of your 95. But also let's assume last year you dropped $100,000 into the market, you had a great year, and you had a 40% return. Right, so that's $40,000 that you would have got from your stock investment income, right, or stock investment return, which again comes in as income. Now, as Brent made a good point, on investment income, the distinction between short and long term is, like Brent said, 12 months. So let's say you put the money in the market January of last year, and let's say you sold that stock investment March of this year. That qualifies as a long-term taxable event, which means you're not taxed at that 22% rate from your job. There's actually no tax on that money, right? And the reason is because for 2023, if you're and we're talking about single individuals here. We're not going to go into all the different variations, but we're talking about single individuals. As long as your investment is 12 months in a day, long-term investment.
Oh, Leon, real quick. Some of you might be wondering why he says single individuals. And we would assume everybody knows their classification on taxes, but some people don't. Some people hand it over to their tax person and they don't even know why we just said that. There are variations of how you file. And some people might file as single head of household. We are not talking about that. We're not talking about married filing separately. We're not talking about that. We're talking about single individuals who also file only for themselves. And so just understand that's a filing classification people give to themselves when submitting their taxes.
Yeah, but we're just going to do the single to make it easy. So
yes.
So again, let's say you dropped $100,000 in the market January of last year. You then sold that position March of this year. That makes it a long-term investment because it's over 12 months. Now, there's the cool thing. So long-term, so in 2023, from zero up to $44,625 is tax-free on investment income, right? So again, investment income, if you $40,000 you made January of last year, you sold it March of this year, that's over 12 months. You take that $40,000 investment income, that is tax-free money. All that goes into your pocket.
Oh,
now here's how
gotta do this too. For anybody who's listening to this, you have to speak to your tax professional when doing this
Yes,
tax
yes,
planning
yes.
strategy.
You still have to
Yes.
file. Yes.
So what we're saying is for informational purposes, everybody's tax situation is different. I just thought about this. And if you don't have a tax advisor or you don't have a tax firm that you work with, we suggest you call Beverly Winstead's company. You can go to www.irshelpattorneys.com. This IRS litigation firm and controversy firm, but they work with individuals with their taxes. And so if you're like, you know what, I would love to know more about this and how it affects me personally, and maybe you're one of those people who do file as married, filing jointly or whatever it might be, something other than what we're talking about today, and you're thinking, okay, I'm gonna listen to this podcast because it's generally gonna be some great information, but at the end, who do I go see? You can go to Attorney Beverly Winstead's website again, www.irshelpattorneys.com. Make an appointment and see how this information is applicable to you. And for anybody who's listening, thinking, "Oh, I'm gonna do it myself," consult the advice of a professional. This is for informational purposes, and we're generalizing a lot of the concepts to make it digestible. So,
Yep. So yeah. So again. So go back to the original point. You made $95,000 in W-2 job income. That's what your tax at 22%. Again, put $100,000 in the market. You had a great year, 40%. 40% return. You sold that position in March of this year, which made it more than 12 months, which now makes it a long-term investment, which according to the schedule for 2023, from $0 up to $44,625 in 2023 from long-term capital gain in returns is tax-free. Right now, Brent said, talk to your tax person, but we're just giving the high level of this. It's tax-free. So now, then we're saying, so how do the rich lower their taxable income by making more money? Well, think about it like this: that $95,000 that you made from your job, you add the $40,000 you made from your income, from your investment income. That's a total of $135,000 you made in income. Let's just say effectively last year, early this year. Now, when you go file, only thing you're going to pay taxes on is that $95,000 of income you made from your job. That $20,900 is only coming from your W-2 job income, right? So effectively, you're paying $20,900 in taxes on your total income of $135,000. That's only 15%, right? And remember, when you were just doing it for your job, you were paying 22%. $20,000 on that $95,000 is 22%. Is $20,000 $900 on 135,000 total income from your income, investments, and your job is only 15%. So this is how the rich actually lower their tax rate by making more money from investments, though, not from other side hustles, not anything that you're going to get. You're going to
1099 or W-2.
1099, right? If you do that, you're not going to get this benefit. This is only for, because these lower tax rates are only for long-term capital gains, right? So don't think you can do this. Oh, if I go make more money doing a side hustle, no. This is only from investment income, things like the stock market, real estate that you hold for at least a year, 12 months in a day, that you can actually lower your effective tax rate by bringing in more money. And this is what the rich do every day. So just wanted to bring this information to everyone and everyone to understand that this is the power of investing that a lot of us don't think about, right? You can actually, again, effectively lower your tax rate by making more money, but through investments. And this is why investing is so important. Jobs are great, W-2s are fine, 1099s are fine. We all have to do that at some point, but please, we got to do this investing thing too, because again, the rich do it every day. Warren Buffett says he hates the fact that he pays more in taxes than his secretary. The guy's a billionaire. She probably makes, maybe a couple $100,000 a year.
I think you meant to say less.
Sorry, she pays. What did I say?
He pays more.
Sorry. Yes, agreed. Yeah, my bad. Warren Buffett. Yes, Warren Buffett hates the fact that he pays less in taxes than his secretary. He's a billionaire. She probably makes, maybe a couple $100,000 a year, but the billionaire pays less because of things like this.
And also, too, I'll say this: the billionaire pays less because the billionaire is hiring people to do and find these loopholes for them.
That too.
The billionaire is hiring and paying to be in conversations in masterminds where these things are being discussed is just as normal conversation.
Yep.
You have to invest in environments that make you better. And I'm not, that's not even just a plug for IAA. We would love to have you as a member, but it is the reality of the world. If you can't know all these things and you can't be amazingly great at all these things. So pay people who are, because the amount you pay them can, not only will it lessen the impact from today, or could it lessen the impact from today, but that lesson may reverberate throughout your life. And you might be able to use that information year after year after year to have a better life than what you have right now. So just you have to invest in your education, and that doesn't just mean going to school.
Right. So the take home from this is that you literally can lower your tax, your income tax rate by making more money through investments. And we went through a scenario here that pointed that out. But this just drills home the fact that we need to invest like the rich do. Right? It's not hard. I mean, a lot of us here that are watching this do this now. Members of IA, you're investing in the stock market, which is great. But we also want to let everybody know that again, long-term capital gains, anything over 12 months and a day, is taxed up to a certain point. There's actually no tax involved. Again, up to $44,625 in 2023. If you took profits this year based on that, you would pay no tax on it. But again, consult your tax person. We're not giving tax advice, but you can just go Google this. It's part of the tax code for this year. But yeah, we just want to show that you can actually lower your tax rate by making more money.
All right. So for everybody listening, number one, we thank you for being with us. We're growing. And for those of you all who are interested in becoming IA members, you can go to IAmembers.com. We're happy to have you come to the fold. And we look forward to talking to you again in 2 weeks. I'm going to do, you remember that? 2 and 2?
2 and 2. We're showing our age.
So we'll talk to you in 2 weeks.
Hold up. Remember, we owe everyone two things, or
2 stock picks.
2 stock picks will be posted in the membership community at IAmembers.com or on the IA mobile app tomorrow. So you better check out that, as long as with the podcast, if you want to watch it again or whatever.
All right, everybody, have a great day. Enjoy your night. Bye.